Okay, Cassie, it's your turn.
Um, Share my screen. Can you guys see it?
Yes.
Okay. Share. Okay, so hey everyone. Thank you for everyone for coming to our second seminar. So this one will be over taxes. And so a brief overview is that first we're going to recap the previous webinar and then dive into today's topics, which is understanding taxes and saving wisely, and then taxes and education and that's their impact on student life. Then we'll move on to mindset, wealth quadrants, and tax strategy. And then we will go over how, like, a conclusion, and then what financial education is and how to join. And then lastly, we will have a Kahoot and a prize at the end if you win the Kahoot. So, yeah. Um, so Chloe, do you wanna?
Okay, so first, rule of 72, and this is just like a number that you would use to determine how many years it would take to double the amount of money that you have invested. And to find that, you take 72 divided by the interest rate, and it, you find the interest rate, you do 72 divided by years to double. So like they're kind of like inverses. And the formula that calculates doubling, that's just the formula. And this applies to today's seminar because taxes reduce the effective return that you get on your investments. And so your money would grow slower and it would take longer to double. So if your annual return were to be 8%, that means the time that it would take to double would be 9 years. However, if you paid 25% in taxes on your investment gains, then you would only be getting technically 6% back because you're losing 25%. So then the time that it takes to double would increase to 12%, which is a 33% longer wait for the same growth.
Cynthia.
So the next topic we were covering was the time value of money. And we went over three main influencing factors. One is inflation, one is opportunity cost, and the other one is value of assets. So starting off with inflation. Inflation is the increase in prices of goods over a period of time, which leads to declining of the purchasing power of money, and meaning that for the same good, you'll be able to buy less of it with each dollar. An example of that can be Starbucks. So in 2000 versus 2025, you have to spend double the amount of money to get a grande drink. The second is opportunity cost. So opportunity cost is basically what you could have spent the money on. Like for example, if you bought a house, you could have spent the same money on different assets like investments or other assets, savings or vacations, and that you lost that amount because you chose to buy a house. So essentially, it's finding like a good balance in the function of money is an important part to a happy life. And third is the value of assets. Starting off, depreciation is the loss of the monetary value of an item over time due to normal wear and tear. And that does count for a business's annual tax liability, which lowers the asset equity. And then appreciation is the opposite. In personal terms, many items start depreciating right after the purchase, like for example cars, and that's why used cars are a lot more cheaper. And it's also affected by supply and demand of the item. And for businesses, those things would be plant assets, and plant assets are tangible long-term assets that are used in a business's daily operations, and those include like office supplies, buildings, land, furniture, etc.
So now over the last topic, which is market value over time. So here, like, these are like the summary. First is inflation, prices rise over time, reducing purchasing power. Market downturns, short-term dips are normal, long-term trend is upward. To protect against this downturn, limits losses during market drops, but also caps gain. Government investments like treasury bills and bonds offer low risk options during uncertainty, and there are two small stock types: small stocks, which allow for high growth, high risk; large stocks, which are more stable and slower growth. So now moving on to the first category, which of today's seminar, which is understanding taxes and how to save wisely. So what is a tax? The basic definition of a tax is that it is a mandatory payments to the government that fund public services. The purpose is to support society and government functions like roads, schools, and healthcare, etc. The goal of taxes is to minimize. The goal is to learn how to minimize taxes legally, and you get to keep more of your money. And a key concept here is tax efficiency, which is managing your money to reduce taxes and grow your wealth faster. So how do you pay your taxes smartly? What is the reality behind taxes? Most people pay thousands of taxes every year. Without smart planning, taxes can eat away your income and savings, and learning how to legally minimize this is essential for building wealth. So here are some examples of tax inequality and how legally minimizing taxes makes such a big difference. So Warren Buffett pays a lower tax rate than his secretary. He earns most of his income from investments and are taxed at lower capital gain rates, and uses donations and tax efficient accounts to reduce taxable income. For reference, he is a billionaire and he pays less than like one of his employees, which is crazy. And Donald Trump paid $750 in federal income taxes in 2016 and 2017. Which compared to ordinary Americans, that is like a huge difference because they usually pay 10K to 20K a year, while Trump only paid 750. And then this is because most Americans, like ordinary citizens, their income are mostly from wages, which are taxed at higher rates than investments, while investors like Trump are use real estate losses, business deductions, and depreciation to offset income. So now moving on to the three main types of taxes. So there are income tax, capital gain tax, and consumption tax. Each type of tax affects your money differently, and understanding them helps you make smarter spending and investment decisions, which legally reduces your tax burdens and maximize your savings and compound growth over time, which we will get into later on in these slides. So what is income tax? It is a tax on the money you earn from working, like wages, salaries, tips, bonuses, etc. This applies to two types of forms. We will go over them later. Employees, which are under W-2, and freelancers or contractors under 1099. And so basically, the more you earn, the higher your tax bracket is, but deductions and credits can reduce your taxable income. So, well, now moving on to capital gains tax. What is it? It is a tax on profits from selling investments like stocks and real estate or crypto. This applies to short-term gains, which are held in within a year, which are taxed like regular income. Long-term tax held more than a year, which are taxed at lower rates. This means that when you're investing in long-term investments, it can reduce the amount of money you have to pay for tax or your tax bill. So some examples of this are stocks, real estate, crypto, and mutual funds. Now moving on to consumption tax. What is it? It is a tax on what you buy. This includes goods and services. In United States, it's mostly the sales tax or mainly the sales tax, and in other countries, it's the value added tax. So examples of this are like groceries, electronics, clothing, and eating out. So now moving on to compounding impact. So compounding is when your money earns interest, and over time, that interest gains more and more, and then interest earns interest. So your money is basically earning its own money for you. So taxes and what's compounding and its correlation to taxes, it's that taxes reduce the amount of money that stays invested. Less money invested means that there is less growth of your investment over time. Even a small tax rate can significantly reduce your long-term gains. So for example, if you invested 10K over 30 years at an 8% annual return, so if you this is at this rate, your investment, if it was tax-free, Roth IRA, then you will get over 100K in return. However, after those 30 years. However, if it was taxed annually at around 22%, which is the usual rate in the US, uh, you only get around 61K back, which is almost half of the money you will get if it was tax-free. So now moving on to the two types of tax forms. The first one is W-2, the employee form. Traditional employees working from companies usually use this form, and some features of it is that employers automatically withhold taxes, like federal, state, Social Security, Medicare, and the employee receives a W-2 at the end of the year showing total earnings and taxes paid. So some pros of this that taxes are handled for you. The employer automatically pays those taxes and deducts that from your paycheck before it even is handed to the employee. And it's also way easier for the individual to file. However, there are some downsides to this. Fewer deductions are available, and there is less flexibility in income reporting. Um, there is the second type of tax form is the 1099, which is the independent contractor form. Freelancers and self-employed individuals usually uses this, and some features of this is that no taxes are withheld. The individual themselves are responsible for paying their own taxes. They receive a 1099 form from each client who paid them $600 or more. Some pros of this is that they have more tax deductions like home office, equipment, travel, etc., to decrease the amount of money they have to pay for taxes, and there's greater control over their income. However, there are also some downsides of this, which are that you must track and pay your taxes yourself. It is really a hassle to some people, and you may owe quarterly estimated taxes. So, what is the main difference between the W-2 and the 1099? So, for W-2 for employees, they pay their taxes first and then spend later. Employer, their boss automatically withholds taxes from each paycheck, and you receive your net income, which is after the taxes, which is easier to manage but fewer deductions. Or basically, there are less leeway around how you can decrease the amount of taxes you pay. So, for example, if you earn 2,000 a month, with taxes withheld, you take home 1,600. And for 1099, they spend first, pay, and then pay taxes later. They receive the full payment upfront and are responsible for tracking and paying taxes themselves. There are eligible for more deductions, like home offices, supplies, travels. And for example, if you earn the same amount of money as before, like 2,000 a month, and you keep all that $2,000 and you pay those taxes later, often quarterly. Oh, so that's it for my slides, and I'll give it to Chloe.
Okay. Okay. Hi guys. Today I'm going to be talking about taxes and education and just seeing how your taxes um can help pay for your education. Oh my gosh. Okay. So first, just like a little overview of what I'm going to be talking about. So first we have FAFSA, then it's going to be part-time earning and tax-free investments, and then education credits and tax benefits. So firstly, FAFSA. So what is FAFSA? FAFSA is this federal application for student aid, and it's need-based. So if your family doesn't make enough for you to realistically spend thousands of dollars a year on college, then the aid that you would get would be more. And this can qualify you for grants and scholarships or loans like student loans. And this paves the way for merit scholarships since colleges can't see colleges can't give you merit scholarships, which are scholarships based on how well you do in school, until you've filled out the FAFSA. And most people are eligible for some financial aid. However, for a lot of people, because I'll go into this later, because it's calculated based on how much their parents make, not how much their parents are willing to put towards their college, this money doesn't help a lot. And this opens October 1st. So, in order to calculate how much money FAFSA gives you, you have the student aid index. And this is calculated using your family assets and income and household size. So, if your parents own like a house or two houses, and there's like 5 people in your family, and this goes from negative 1,500 to 999,999. And the lower your SAI is, the higher amount of need is demonstrated. So the more financial aid you are going to get. Then we have family income on FAFSA. And parental income actually has the biggest impact but it isn't the entire thing. 50% of student income counts towards SAI. However, there is a limit, or there is like a minimum that you would have to make to like qualify for 50% of your income to count. So if you made less than that, it wouldn't count. And your parents' assets also count for 5.6%. Retirement accounts and cash value life insurance accounts, however, do not count. And for the student income, that counts towards the SAI, only the income above 11,130 counts. So here's like a chart on that. Your parents would count 22 to 47% of the income above the protected amount, and plus the assets up to 5.64% of non-retirement accounts. And then for students, this is 50% of all income above 11,130 and 20% of all of the assets in like your savings account. So then now we're going to see how smart planning can actually help you increase aid. So for parents, different FAFSA weighting. Parents, if they put stuff into savings, if they had $10,000 in savings and invested, that would lose them $564, which is 5.64%. However, because for students, the same amount of money in the same type of account, if it was in the student's name, it would lose them 20% or $2,000. Next, we have income timing. So FAFSA uses tax information from 2 years prior. So if you're filing your FAFSA in 2025, like a lot of seniors are, you would pull out your tax information from 2023. So if you're expecting a bonus, you would strategically time it for a year in advance to avoid potential FAFSA SAI increasing, which will lower your financial aid. Then we have low student income. Students who make above $11,130 will have to they'll have to like count 50% of that towards the FAFSA. However, if you were to work less than that, you would just plan to work fewer hours to limit the amount of money that you're making so that you don't end up going over the threshold. You could also start like putting your money into a Roth IRA if you did make that, since those contributions don't count as FAFSA assets, and that would put you under. And then for your shelter assets, just contributing, like I said, to your cash, like retirement plans and cash value life insurance, because those plans do not count. And this like lowers the taxable income and FAFSA assets. And also keeping college savings accounts in parent-owned plans and not in the students' names because, again, the parents are going to have less of a percentage taken away than the students. Now we'll move into part-time earning and tax-free investment. So there are two paths to investment. First is a cash value insurance, and next is a Roth IRA. So what is a Roth IRA? A Roth IRA is a retirement account that you can put money in and let it grow. It's tax efficient for the future since you don't pay taxes on that earnings. So any student with a W-2 or a 1099, as I think Cassie mentioned, which is just like your employer tax forms, whether or not you pay taxes by yourself or your employer pays them for you. And you can contribute up to $7,000, but it just depends. Like if you make under 120,000, you get the full 7,000. If you make 150, you get partial contribution based on a special formula by the IRS. And then over 165,000, you are not eligible for a direct contribution because there is a limit. So now for the benefits. So these growths and withdrawals are tax-free. So the amount of money that you put in and like depending on how long you leave it for, how much money that has grown in that account, that will not be taxed. And these contributions can be withdrawn without penalty. So if this retirement account were to be taken out when you turn like 65, like I'll mention later in the life insurance account, there will be no penalty. There is no deduction for taking it out early. And additionally, this is not counted in the FAFSA because, well, this is just not counted in the FAFSA. And then some drawbacks for this. It's a low limit. $7,000 is not that much money, especially if you do make a lot, like since the maximum is for the full 7,000 is 120,000. And the earnings, not the contributions, can be taxed and penalized if withdrawn before a certain date. So you can take out the money that you put in, but you can't take out the money that's grown. Next, we have cash value insurance. And some pros of this are a tax-free investment, just like the Roth IRA. However, this is more flexible than the IRA from the Roth IRA, and there is no income limit. So it doesn't matter if you're making $100,000 a year or $3 million. There's no limit on how much you can put in, and there's no limit on if you can put money in. And then there's a wide contribution range, and and you can use this money before you turn 59 and a half, which I'm pretty sure you can't do with a Roth IRA. And then the cons of this is it's a very long-term investment because you typically won't see this money until you're old. And because it's life insurance, you do have to be healthy to qualify, just because they don't want you buying it and then dying, um, because of a sickness. So, but either way, both are great vehicles to save taxes in the long run. So now we're going to move into tax credits and education benefits. So first, there are two main ones under this category. There's the opportunity tax credit, which I'll talk about first. And this is just a federal tax credit designed to help students pay for college. And you must be an undergrad, so you have to be in your first 4 years of college. And the max you can get is $2,500. And this amount is refundable up to $1,000 or 40%. And in this graph, it's just showing you get 100% of the first $2,000 of qualified expenses, 25% of the expenses in the excess of $25,000, and the maximum that you can get is $2,500. Next, we have our lifetime learning credits. And this is not limited to the first 4 years. So it doesn't matter if you're like 40 and you're taking college classes, or if this is just your first year. It doesn't matter if you're an undergrad or a graduate student. And you claim the first 20% of the first $10,000. So that would be $22,000. And it is non-refundable. So you can't get like money back that you've spent, as seen in like the graph. Let's see. And this is just talking about when you can claim these. So because these two are very similar, you're basically getting qualified education expenses paid for during the tax year. And you can claim the American Opportunity Tax Credit if you haven't claimed it for over 4 years. And if you're a single person making under 80,000 or married and making over 160,000, you can qualify. Um, yes, and then for the lifetime learning credit, this is claimable anytime a student, again, is in school and meets the requirements. So you can claim it for any number of years. However, you can't claim the American Opportunity Tax Credit and the lifetime learning credit in the same year for the same student. However, if a parent had like two siblings going in college in the same fiscal year, you would be able to claim the American Opportunity Tax Credit for one kid and the lifetime learning credit for another. And that's all I have. I'm gonna pass it over to Cynthia.
Alright, hey guys. So, are you guys able to see the slides right now? Or are you guys able to see the slides?
Yes, we can see it.
Okay. So, today I'll be talking about mindset, wealth quadrants, and tax strategies. So, starting off, we talk about cash flow quadrants, which comes from the book Rich Dad Poor Dad by Robert Kiyosaki. It's the #1 selling finance book in the world right now.
Sorry, Cynthia,
So,
I cannot see your screen. Anybody else can
oh,
see Cynthia's screen?
okay, can you guys see it now?
Yeah, but it's not a full screen.
Okay,
Yes, there you go.
it's good? Okay.
Yeah, thank you.
So we'll be talking about mindset, wealth quadrants, and tax strategies. The concept of cash flow quadrants come from Robert Kiyosaki, which is the author of Rich Dad Poor Dad. And basically, he divides cash flow quadrants or tax quadrants into four main categories that can be abbreviated by ESBI, from highest to lowest taxes. So starting off with the highest is employees who are individuals working under an employer. They earn gross wages, but those gross wages are like taxed and they get a net pay. Those taxes usually average around like 30 to 40%, which is pretty high. And then next is S, self-employed individuals. They work for themselves rather than like a system under the employer. And their income is tightly tied with the product or the service they are able to provide. And they do pay a less percentage of income tax, but they do have to pay self-employment taxes. The third is business owners, which is lower. They're the owner of a system and they're the employers that hire the employees. They are able to use the business to reduce taxable income legally with deductions, depreciation, and business expenses, which are tax deferred or tax free in comparison to personal expenses. And I think Cassie mentioned it, how billionaires are able to pay less taxes. Another method used by Elon Musk is that he would, instead of a salary as CEO, he would take the stocks of Tesla and then go to a bank using those high credibility, high potential stocks, and he gets a loan out, and then he spends that loan because a loan is a debt, so you don't get taxed for a debt, and that's how he's able to live tax free if he's like, or like pay less taxes if he's paying any. And then the which is tax lowest in tax, which is the investors, they earn passive income through investments with like dividends, capital gains, and investment incomes instead of active. And to differentiate these taxes, we have another slide here. So ES is like the higher tax rates, and that is because they earn active income, like the tax dependent hourly wages. And those are like those require like high taxes, and then for the self-employed individuals they also have to pay another self-employment tax. And then for B and I, which is business owners and investors, they are able to require like less effective taxes because they mostly earn income through passive or leverage income, which comes from like rental properties or partnerships. And using their businesses, they're also able to use tax benefits from business deductions, depreciation of assets, capital gains, which is a lot less than income tax, and deferrals and shelters, which is reinvestment into their own company. So shifting from high to lower quadrants, there are many methods to start doing this. First of all, financial education, knowing your tax terms, your basis, your job status, etc. It really helps. And then the next one is mostly for self-employed individuals to move into lower the lower quadrant, which is business owners. They can create like more scalable systems, which allows the transition. And then next, investing profits back into the company. And lastly, using legal tax strategies to lessen tax burdens. And this includes incorporating, reinvesting, and use of tax advantage accounts in order to like minimize taxes as much as possible. The main takeaway of this book from Robert Kiyosaki is the poor and the middle class have work for money, while the rich people, they make the money work for them, meaning that they're able to like manipulate the money and then use money to like grow money and reduce the amount of expenses. The second topic is entrepreneurship, specifically for students. So the benefits of starting entrepreneurship at a young age is, first of all, the quadrant shifts. It allows the students to go from a higher quadrant to a lower quadrant at like a young age and have that experience, developing soft and hard skills like designing, marketing, finance, communication, management, which is essential in life later on as well. And then also personal growth, because while you develop a business, it directly teaches you about management and then a lot of financial literacy and independence throughout the process of owning and managing the business. Here are the different types of startups. So starting off with the two most common ones, they are the sole proprietorship and the LLC, which is the limited liabilities corporation. So the first one, it is the easiest form. There is no separation between the business and the owner in terms of liability accounts, meaning there is no liability protection. And you do have to pay self-employment taxes for this type of business. The next is LLC. This is the most common and most convenient and less risky method and type of startup. So the business and the owner, they have like separate liabilities, which provides liability protection, and it's has like a flexible taxation. Could be for a partnership or a sole business. And then next off is S Corp. It is more complex and it is more for like smaller businesses. Salary, you can pay a salary to yourself, and the extra profits can be used as dividends to give it to yourself, and dividends are also taxed less. It does require more paperwork and have more IRS rules in the process, however, and it avoids double taxation, which is good for potential payroll tax and helps you save money. And then C Corp. C Corp is basically what you see for stocks, and it allows raise for investment and issuing of shares. It is more complex than the other three, and it is able to separate legal entity as well, like an LLC. The business and owner have like separate liabilities, and it doesn't avoid double tax rate like S Corp, and it also requires like around a 21% federal corporate tax rate. Unlike the S Corp, it's usually like the larger companies. So reducing tax. First of all, you can track all business expenses because business expenses are usually tax-free or tax-deferred in comparison to normal personal expenses. And then also forming an LLC or S Corp, these structures kind of allow you to kind of pay yourself a reasonable salary, and there are additional like profits that you can take as distributions, and like they are taxed a lot less in comparison to salaries. And investing back into the business, again, reinvesting into your own business, into equipment, marketing, etc. It's a way to like kind of avoid income taxes. And then the use depreciation. So depreciation is a part of expenses, and then assets minus the liabilities is what you get for your income, and it decreases the income as an expense. And so leverage tax credits, there are a lot of organizations and credits out there that students can use to like support like student entrepreneurs on like taxes and helping them like start a startup. An example being the American Opportunity or Lifetime Learning Credit. And it helps business deduction simultaneously. Planning for the long term. So shifting from earning active income early on into passive income, it really helps like you and your employers because of how the tax differences from active versus passive income. And then lastly, profits. So usually starting off, it's either like a neutral profit or you operate at a net loss. And then this negative income cannot be taxed, like for first year entrepreneurs usually. The third topic with taxes in mind, we have investments. So starting off with types of investments, we have stocks and ETFs. This is shares in a company or index fund, and people profit from the growth of a company, which results in an increase in stock price. There is a capital gains tax on this, however. And the second most common is real estate. So buying property or rental income or appreciation, and retirement accounts, which was mentioned previously. This includes like 401s, IRA, and Roth IRA, and these accounts are usually tax deferred or tax free withdrawals. Dividend stocks, um, and differing from like normal stocks, these are regular income from a company profits directly to a shareholder. And for the taxes, the qualified dividends are taxed at a lower capital gains rate. Tax advantages. So long-term capital gains, for assets held over a year, there are lower tax rates, and these tax rates depend on your income. And tax deferred growth, using accounts like 401s, IRAs, or 529, 529s, it allows investment to growth without like much annual taxes on the gains. And then dividends and compounding, it helps delay taxable events and also boosts compounding returns over the years, which increases. So here's a starter roadmap into investment. So first of all, just start investing, even if it's like a small amount per day or per month. It can definitely benefit from compounding as long as you're able to like start earlier. And while you do that, also know the basics of investment and financials. So being able to understand tax terms, capital gains, deductions, deferrals, basis, and everything like of the like is really important as you invest. Three, as you start becoming more experienced and you start to diversifying gradually your investments across like different types of assets like stocks, bonds, real estate. And lastly, think in like decades, not days. So like think long term instead of just what is happening right now because the market is always changing. So always be sure to like have like a steady and calm mood while you're investing because it can like grow one day and then suddenly drop the next day. But that is like very normal. So remember to have like a calm mood while you're investing and then be consistent with it. That is the end of my presentation. Thank you.
Thank you guys for coming. This will be the end of our second webinar. We really appreciate your time to be here. And so before we move on to our Kahoot and prize, we're going to briefly go over what financial education is and what we do, and then how to join. So, our mission is to empower students and families through financial literacy education, like webinars like these. And the purpose of this is to help young people build smart money habits and prepare for college and careers. So, here are some opportunities we offer for high school students: volunteer programs, leadership development, financial literacy workshops. All of these examples help strengthen their college resumes, and we also like volunteer hours and like leadership development, as I said before. And then, so if you want to get involved, which we definitely would love and recommend, scan the QR code on the screen. It's a WhatsApp like group, and then we basically post a lot of like information and like updates on there, and then or you can talk to your inviter after the session to like say, hey, like what can you do to join, and like what can you like how to get more involved in this. And then so Chloe, could you share screen for Kahoot? Yes, give me 1 second. Yeah, of course. Okay, it's actually gonna be a Blinkit. Oops. It's actually gonna be a Blinkit. So just join the code at playblinkit.com. It'll be 502-507. Um
So Chloe, are we supposed to go to the website?
Yeah, you're just gonna go to this website. I can type it in the chat
Yeah, please.
if you want to just tap. You can just tap on that and it'll take you to this. And then you can type in the game code.
That's fancy.
Wait, do you need to share a screen so we can see the questions, or is it?
Yeah, because I did it like the Kahoot style one.
Oh, okay, okay.
Did everybody join? So we use the link and put the game ID, and your name will be showing in the screen on the screen.
你看前面有 link， no.
Yeah, everybody is encouraged to participate because the winner will have get my gift card. Okay, you don't want to miss it.
Question here.
Sure.
So for each game, is there only a single owner or there can be multiple owners?
Yeah, Cassie, can you explain the rule? How we pick the winner?
Oh, yeah. So basically, there are 15 questions, and then whoever answers it correctly and the fastest will basically get the prize. I believe it's like an Amazon gift card, $15. There will only be one winner, and then it will pop up on the screen with like the winner and the like runner-ups.
Cool, thanks.
Yeah,
Okay, I
thank you,
guess
Cassie.
adult should be limited from participating here, but we can observe.
Okay, well, if that's everyone, I'm gonna start the game. I'm pretty sure you can still join, even if I've started.
Oh, we got a winner. That is fun.
Congrats.
Congratulations, Michelle.
Also, congratulations to Kenny and Selena. Good job.
Yeah, you got super close.
清楚几个，第一个就是
So, Michelle, yeah, you got most of the answer right. Can you share a little bit to everybody? You got all the knowledge from today, or you have learned from somewhere else before?
Well, I've read the book that by the author that we were talking about today, and then I'm in econ right now, so I think that kind of gave me some background knowledge. So yeah.
You mean the Rich Dad Poor Dad?
Yeah.
Oh, that's great. Yeah, everybody, yeah, it is recommended to everybody. It's a great book. Okay, congratulations. And oh, Peter got the fourth second. Good job, Peter. Okay, so Michelle, if you can, who's your inviter?
My mom.
Okay,
Oh,
okay. Yeah.
yeah.
Let your mom contact us and give us your email address, and gift card will be sent to you.
Thank you so much.
So yeah, that will be all of today. And our program is every once a month. And thank you everyone for participation. So in the future, if you or your surroundings would like not only participation but want to be presenting, let us know. Yeah, we are opening to everybody to get on the platform. Yeah. Thank you. Thank you, all our presenters. You did a really great job. Okay, so that is for today.
对，但是排
Thank
气密
you.
报它应该进的
Yeah, thank you for coming. Good night.
Thank you.
Thank you.
Thank you. Bye.
Bye bye.